All right. Hello and welcome everybody to today's workshop. I hope you're doing very well. I want to say a big happy Father's Day to the fathers here. So I hope you're all having a wonderful day. And maybe you're out fishing while we're doing this workshop here, or just going out to dinner, and that's fine. You could definitely watch this at a later time. But I personally want to wish you all a very happy Father's Day. And I have a little video here I want to share with you because I think it will be great. But before I do that, let me introduce myself. My name is Jason Hamilton. I'm a certified financial planner and the founder of Keep It Simple Financial Planning. And every Sunday, about 2 o'clock p.m. West Coast time, Pacific time, we're going to do a workshop for you. We're going to talk to you about things around retirement, finances, investing, taxes, Social Security, healthcare, all the things that are going to be affecting you as you go into this next stage of your life, also known as retirement. So for most of you folks there, you have a couple years still, maybe more. And so the earlier you get prepared, the better. That's definitely the case from what I've seen. So every week we're going to try to bring you some knowledge, some insights, and some information to help you become a better prepared retiree or pre-retiree, you could say. So again, welcome. And for those that just tuned in, happy Father's Day. It is Sunday. It's one of the best days of the year. We definitely celebrate fathers around here. We know how big of an impact they can have on children's lives. So we want to say thank you to all the fathers that are out there pushing through every day to provide and be good examples for their children. So before we jump in, we're going to talk today about bonds. These are one of the things that aren't really talked about a lot of times, and everybody generally knows that you need to have some amount of bonds or some general things like that, but they don't really understand what type of bonds there are, the role they should play, and some other information about them I think you should know. So we're going to talk about that. But before we do, there's a video that one of my good friends, his name is Charles, put together, and he asked me to participate in. And so I want to share this with you. It's a really, I felt it was a very positive message for our fathers. So we're going to do that real quick. It's about a minute and a half long. So stick with us and enjoy that. And then we'll get back to more of the technical financial retirement planning information. So let me pull this video up here.
Hi, my name is Charles Dorsey.
Josh Hughes.
Jason Hamilton.
Steve Adams.
This is Zuko Lella.
Brian Hill.
Dr. Nduka Yunaka.
Dr. Milo Dodson.
Benjamin Christie.
Charles Wright. Brian.
Jason Aguilar.
Brian Ferris.
Satoshi Suga.
Fred Lipscomb.
Mazar Hooker.
Quentin Brooks.
Mike P.
Spencer Pasinger.
Todd Anderson.
Rema Ehiemery.
Joseph Williams.
James.
Joshua Fathery.
Mike.
Brian Ford.
Drew Hyun.
There's Brian Lloyd Bailey Sr.
Elgree Jones Hurd III.
And I want to let all the fathers,
All fathers.
Hey,
are you guys out there?
All the fathers.
good, strong fathers,
All the fathers. All the fathers.
All the fathers.
All fathers.
All the fathers.
All you fathers.
All fathers know. From the sons to the dads.
First of all,
We see you.
Your effort is noticed.
You are an awesome father.
you are
Just as important.
you're
Highly appreciated.
doing a good job.
Your value.
You have meaning.
We love you.
We need you.
we celebrate you.
You're special.
You matter.
Your voice matter.
Your presence matters.
Even more.
No matter what.
Be joyful. Embrace it.
Just really take a moment and realize the job that you guys are doing.
It counts for a lot.
Please don't stop. You're an inspiration.
Don't ever forget that.
So if you're one of those men,
Believe in yourself. Be bold.
Be fulfilled every morning.
Be well.
Set an example of love, of peace, to look up to, a role model, and
keep up the good work.
Making sure
In the next generation.
Next generation.
Our next generation.
Future generations.
instead better than us.
And because of you,
Everybody wins.
we can't do this without you.
So,
Happy Father's Day.
Happy Father's Day.
Happy Father's Day.
You guys have my respect.
And this is what happens when fathers and sons speak.
So what did you think? I thought this video, I had no idea what it was really going to be put together. My friend Charles, who opened up the video there, just asked me to do a 30-second clip and just give some thoughts about fathers and share a little video. And it was really cool, I think, how it all came together to be something very special on this very special day. I think one of the biggest challenges we're facing in this country right now is the lack of fathers in the homes and in their children's lives. So I really want to celebrate that and really celebrate you fathers that are out there doing the hard work, of being the leader of your family, and for the single mothers out there, we definitely respect you as well. But since today's Father's Day, I want to take a minute to just really point out the strong fathers out in the community that are doing the right thing. So I hope you guys enjoyed that. I'd love to hear any feedback on that from you. But today we're going to talk about some fun stuff. Okay. We're going to talk about bonds. Okay, so I wonder if anybody can give me a comment, and if they can give me a good description of what a bond is. So for those of you that are listening live, what is a bond? Can anybody answer that question? And I think most people know that, they need to have some sort of stocks and bonds in their portfolio, but they don't always know exactly what a bond really is or what it does and the point of it in the portfolio. So I'd love to hear from you if you have any ideas on that. I haven't seen any comments come through yet, so we're going to just move forward. But the name of today's presentation, or the title I should say, is called Bonding with Your Portfolio. Okay, just a little play on words there. And not that you're going to fall in love or anything like that, which you shouldn't fall in love with your portfolio, by the way. Your portfolio should not be emotional to you. I know many people get very emotional to some stocks that they have held for their whole lives, or maybe that their parents gave to them from an inheritance, things like that. And, but again, it's do not fall in love with any sort of investment. Make your investment choices based on logic and the place they should have, in your portfolios. So Jimmy said a promise to pay you funds at a future date. I think that's definitely one part of it. So you're essentially going to be loaning money to something, and we'll talk about this a little bit, but you're going to be loaning money to a corporation, maybe to a government of some sort, with a promise that they'll pay you back at a future date. And in between the date that you loan your money and the date you get your money back, you should be receiving something called a coupon, which is essentially interest that you will earn, over the year, generally paid out twice a year. But can be different depending on the source. So let's talk a little bit about this. So before we jump in, as always, I have to let you know these workshops are for education purposes. They are not tax, financial, or investment advice. So please always work with somebody like a certified financial planner or a certified public accountant before you make any choices. But ideally, you're going to be smart and not do things just because I tell you. You want to do your research and make your own decisions there. So let's jump in. So bonding with your portfolio. So nearly all investors realize the importance of diversification to the investment process, right? Many may not be as familiar with the importance of asset allocation though. So asset allocation means dividing your portfolio into the appropriate mix of stocks, bonds, and cash. And then obviously we can break this down into different types of stocks, right? Different categories of stocks or asset classes and different types of bonds. And obviously cash is just cash, so that's pretty straightforward. But, although assets, they can also include real estate. So like your home, your vacation home, if you have one, rental properties or business ownership. The most widely held asset classes are stocks, bonds, and cash, okay? So in a strong economic climate, like we were experiencing up until 2019, 2020 has been a little bit shaky, but hopefully things are turning around. The potential to gain when stocks perform well opens up, right? So when the markets are doing well, stocks are generally where you want to be, because stocks are generally going to give you the highest returns. But typically, most people who invest in the stock market also see value in having a liquid cash or reserve set aside for emergencies and larger expenditures. But what about bonds? Are they affected by economic swings, and what are those risks involved? So there are some risks with bonds you have to be aware of. The number one thing is called interest rate risk. Okay, so that's associated with investing in a bond or a bond mutual fund, and it is referred to as an inverse relationship. Okay, an inverse relationship. So that means, and this is general. Okay, so this is most of the time. This doesn't always happen 100% of the time, but as interest rates rise, generally prices of existing funds with lower interest rates will fall. Right. So if you have let's say you have some sort of bond funds, or you even own some bonds, and let's say it is a 5-year duration or 5-year term on that bond. Well, if you keep that bond for 5 years, you're going to get paid a certain amount of interest over that time. But if interest rates go up, which means if new bond issues come out and you can get a higher interest rate, that's going to cause the price of your existing fund to lower, right? So, and then vice versa, right? As interest rates go down, as interest rates are now at, let's say, 0 to 0.25, if you have bond funds that you've had for a while that are paying you out 3%, for example, or 5%, well, that's going to be more valuable than what you can probably buy today. So there's an inverse relationship there when it comes to, bonds versus the interest rate prices, bond prices versus interest rate prices. So when considering bonds in your investment portfolio, most people in retirement, probably most folks here that are within 5 to 10 years of retirement, are going to want to have some sort of a range of maybe 30% to 40% bonds up to, 60% or even 70% bonds, depending on your risk level. If you look beyond those, there's not a huge gain or loss if you go 10 or 20% above or below that range of 30 to 70%. But this really is important for you to understand your personal risk tolerance. And so your personal risk tolerance is going to be, one of the biggest factors, along with your necessary returns that you need to have for your overall portfolio. But another way I want you to think about bonds is kind of a shock absorber in a sense. Because generally, when this coronavirus deal happened and things started going down back in February and March, some of the bond funds, some of the biggest bond funds that have been around for a long time, but have never seen anything quite like this, saw huge dips because of the illiquidity in the markets, right? So if you didn't know, bonds are a little bit more difficult to trade and sell than stocks are. Stocks are considered very liquid, and there's generally always somebody you can always swap those out, and that's why you see a lot more of day trading type of things and high-speed trading within the stock market. Don't see so much within the bond market. And when back in February and March, when the market became less liquid, then what happened was people were trying to get out of their bonds and move to cash, and so it was much more difficult to get out of those, and that's why we saw a lot of bond funds, even decent quality bond funds, drop quite a bit. And I've talked about this, in the past as well. So, but there are definitely some good reasons to own bonds. Something to think about is they may generate more income than stocks or cash. Especially cash right now is not going to generate hardly anything. And so this is something really important to consider if you want to generate some more income on your portfolio. Bonds can be a good way to do that. And sometimes the income is free from state and federal taxes. So we're going to talk about that as well with certain types of bonds. And in addition, bonds can be timed to mature when money is needed for a specific purpose, such as college tuition. So you may have heard of something called a bond ladder. And what bond ladders try to do is have a series of bonds that are going to pay out over certain numbers of years and have a guaranteed amount of cash that they kick off. So that would be from more of, for somebody who's looking for income, for example, or also, college tuition that should be done at a certain time. I think those things can be very important. So let's talk a little bit about types of bonds here. So the big one, a lot of people are probably familiar with here is corporate bonds, okay? So corporate bonds are essentially, if you were to lend money to a corporation and they're going to use that money to then, expand their company, right? And for you lending money to that corporation, they're going to pay you some sort of interest payment, also known as a coupon payment. So when buying corporate bonds, you may want to stick with the higher grade, right? So if you're not familiar with how bonds are graded, there's multiple scales, but the general one you're going to look at, I believe it's the Standard & Poor, is rated from AAA as the top to A, considered to be high grade. And then it goes triple B to B, and then anything below B, I think even B and below is considered junk, right? So junk doesn't necessarily mean you don't want to own that, it just means higher risk. Doesn't mean that it's junk, you would throw it in the trash. It just means you're going to get a higher interest rate on those, but you're also going to be taking a higher risk. So doing some of the studying I've been doing lately on bonds, what's happening now with interest rates dropping so much is you're going to see a lot of bond funds try to add higher risk bonds in there to try to squeeze out yield. I don't know if that's the right thing to do, because if we do have markets downturn again and you have a lot of higher risk bonds, you're going to see a much bigger effect to your overall portfolio than you would if you had higher quality bonds. But these are things you need to look at as an investor. So bonds below A, despite sporting higher interest coupons, are riskier. So there definitely is a risk. And really the scale is based on the risk of default, right? So if you're buying a bond and you are essentially lending money to somebody, then if the lower risk of default, the higher quality that bond's going to be. But the higher quality it is and lower risk of default, then the less it's going to pay you. Just like if you were to, let's say, buy a car or get a mortgage, the lower your credit score is, the higher interest rate you're going to pay, because the higher risk you are to that lender, to the bank, that you might default, right? Kind of similar here. This is how things work. So maturities, in the intermediate range are about 5 to 10 years. Those are generally considered like the sweet spot on the yield curve. But if you have enough money, I would definitely consider buying several different maturities in this range to avoid all of them coming due at the same time. And selling a small bond lot may penalize you, so considering holding the bonds to maturity. Because if you're selling bonds in the middle of their maturity, technically the price of the bond could be down because things like interest rates have gone up, for example. So these are things that you want to think about. I like to keep some very short-term bonds in portfolios because we may need to use those for things like just generating, the money you need on demand. But over time, you want to have a good mix of maturity. So, 30-year maturities might be a little bit long, but you might have some of that in your portfolio. But with what things are paying now, seems like that might be a little bit on the long side. Okay. All right. So that was corporate bonds. So let's talk a little bit about municipal bonds. So municipal bonds have some really great things potentially about them. Generally, the payment or the coupon you're going to get on this bond is going to be adjusted, right? So if you're comparing two bonds, like a corporate to a municipal, you want to look at the after-tax payment. So if you're going to get paid on a corporate bond, for example, outside of a retirement account, you're going to pay your normal tax rate, and that'll be your marginal tax rate. So if you're comparing corporate bonds to municipal bonds, you want to look at when the municipal bond is going to pay, since this is generally going to be tax-free to you, and compare that to a corporate bond and see what's going to net you the highest amount after tax. But so municipal bonds, they generally generate income that is free from federal taxes. And it is free from state and local taxes for investors who reside in the state where the bond is issued. Okay, so if you reside in the same state the bond is issued, then it will be free from state and local tax as well. So these are generally good investments for people that are in high tax brackets. So especially residents of high tax states like New York and my state of California. Really ridiculous here with the tax rate. So municipal bonds outside of your retirement accounts can be a good way to go. So, but because of their popularity, there's usually an ongoing schedule of municipal offerings throughout the year, and municipal bonds are also rated. And, it might be safe to stick with the higher rated bonds there. Generally, again, you don't see too much of these fail, but they do fail over time, and that could be your principal at risk there. So for smaller investors, the bond portion of a portfolio can be obtained by investing into a bond mutual fund. Okay, so bond mutual funds are going to be the way that most people access. Very few people buy single bonds anymore. But again, for something like a bond ladder, that could be something you might want to consider including in your portfolio for retirement income. So the third type here we're going to talk about today are bond funds. And these can break down to quite a few categories, but most people are going to have bond funds, and these bond funds are going to have a mixture. So bond funds or mutual funds and invest in bonds, those are a little bit interchangeable. These are a little bit more flexible. These can be bought or redeemed more easily than individual bonds. So if you're trying to, rebalance your portfolio, it's pretty easy to sell off a bond fund, buy some more of a stock fund, get back to your allocation. But if you have individual bonds, and let's say they're local municipal bonds, that might be a little bit more difficult to sell. And so it's not quite as easy to rebalance back if you need to do that. But when you're buying a bond fund, you're essentially buying diversity or diversification, right? That's what you're looking at when you're buying a bond fund. You want to have a wide variety there. So you're going to spread that credit risk among a number of issuers. So this is the nice thing about bond funds. You might have, 500, 1,000, or even a few thousand different bonds inside of one fund. So even if 1 or 2 or 10 or 20 or maybe even 100 fails, you're not going to lose all of your money there. So this is why bond funds have become so popular. And those are things that you might want to consider as you are choosing your bonds in your portfolio. Many funds do have special features such as automatic dividend reinvestment and check writing privileges. So you can look into that, for those as well. But the thing to consider with bond funds too is you're getting professional management, which should help the fund weather interest rate fluctuations. So people that are, managing these funds, it might be 1 or 2 or 3 or generally not more than 5 people that are managing a bond fund. And so they are specifically focused on that fund. So instead of you trying to pick individual bonds that you hope don't default, generally by having some professional management, those are things that can really help you eliminate, or I shouldn't say eliminate, but reduce the chance of default and weather those interest rate fluctuations, because interest rates are generally always going, up and down. But in most cases, a bond will mature at par or face value. Okay, so what that means is if you buy a $1,000 bond today, and that is it has a 5-year duration on that bond, the bond might fluctuate. It may go down to 800 or 900 in between, may go up to 1,100. But once that bond matures, you're going to generally get back your $1,000 that you put in. So that would be your par or face value. So while the managers of these funds are always repositioning the funds to maintain the stated maturity, which can be positive or negative, right? So these are really things they have to consider depending on the direction of the interest rates. The professional managers generally do a pretty good job of this. And there's, some quite large bond funds. You can buy an index bond fund and, or either actively managed bond funds as well. So you have to really look at that. One of the biggest things with bond funds that are going to determine how well you do is actually the cost. Okay. So these are things that are very, very important. You want to look at something called the prospectus. Okay. The prospectus for any fund you're considering looking at. And you want to look at the cost, the all-in cost of the fund, which would be stated there right there on the prospectus, or really probably on any homepage of a bond fund. And you want to look at the turnover percentage. Okay, the higher the turnover percentage, generally the higher the cost, and the higher the cost of a bond fund, the lower your chance is of beating just a general index. Okay, so buying an index, you can get a bond fund for a very low cost, maybe 0.1%, 0.2%. Very, very low cost. And so I have seen bond funds that really hurt my stomach a little bit at some of these larger name broker dealers that have over 1% costs, okay, in a bond fund. I've seen up to 1.49 recently. This is within the last 90 days that I've seen this. And these are, household names, right? These are the investment companies that are on your corner in all your small towns. And the likelihood of you actually outperforming more than that 1.5% over a 20-year period is about less than 3%. So you really, anything once you're getting above about half a percent or 0.50 or 50 basis points, those are all different ways to say the same thing. You really start putting yourself in a position to not have that fund be worth investing in, because over time, that high cost is going to eat away at your returns and your coupon payments, especially in today's low rates environments. So you definitely want to look into that as you are making your selections. Okay. But bond funds also enable investors to tread territory that may be a bit off the beaten investment path. Okay, so examples of specialized funds include high yield funds. Those are also known as junk bonds. So if you look in your portfolio, or maybe your 401k or your IRA, and you see something that says high yield bond fund, that's generally going to be junk bonds. Okay, so that's going to be higher coupon payments or higher interest payments, but also higher risk. Okay, another type of bond fund is an international bond fund. Again, I'm a big fan of diversifying internationally or globally, so I definitely like to have some international bond funds. But think about you doing your own research and trying to pick individual bonds from somewhere around the globe. You may be familiar, but most likely you're not. So these are cases where you might want to trust a professional manager to help you out with these things. You can also look at emerging market bond funds. So again, these are things that if you're looking at countries like, emerging markets are considered, India, Russia, Philippines, Vietnam, those type of countries. Will you personally have the expertise to go in and design a bond portfolio for yourself that will keep your, your coupon or your returns at least average or higher than expected, while your risk of default next to zero? Probably not, right? So this is where you want to look at professional management for these type of funds. And there also are multi-sector bond funds that combine different types of bonds. So we have different government type bonds, different foreign bonds, different corporate bonds. We have mortgage-backed securities, and we have inflation-protected bond funds. So these are all different types of bond funds that you may want to include in your portfolio. And in all honesty, I am a fan of keeping different types of bond funds in portfolios, because if you have everything in one type of bond fund, unless it's like something like a treasury, you can really have a lot of risk if you're too heavy in any one sector. And this is where the idea of diversification comes in. So, when venturing into this more exotic realm, it's definitely prudent to research fund managers' track records and their performance and their consistency. Okay, so as with any investment and in all mutual funds, investors should really remember that there are specific fees and expenses associated with the management of a bond fund, and any fees and expenses should be outlined in the prospectus, and they should be considered before investing. So I don't know if any of you have ever thought this much about your bond funds in general, but these are things that I think are really important, and you want to have an understanding of your overall portfolio and not just select the bond fund because it says bond fund. Some of you are going to have things like, the TSP, for example, which only has some limitations. You'll have the G fund and the S. It's on the G fund and the S fund, I believe. Don't quote me on that. I think that's what it is. But no, the S fund is a small cap. The G fund, and there's another one. Anyways, but you're very limited in your choices. But for those of you that have 401ks or IRAs, you're going to have generally a lot more choices when it comes to your overall bond selection. So you want to keep different durations. You want to keep different credit qualities and possibly even globally diversify your bonds and look into things like mortgage-backed securities and different things like that, because having those different types of funds will, again, lower your risk, add to diversification, and generally help you out with returns versus just sticking with one category the whole time. So hopefully you found this interesting. I'm going to jump over to some questions now, but I want to thank you so far for anybody who is watching here today. All right, let's switch back here. Oh, the F fund. Thanks, Riola. The F fund. That's what it is. Okay. So I try to remember these things. The F fund in the, there's a G fund and the F fund in the TSP, which are kind of your selections there. And again, not bad selections generally overall, but you're not going to get quite as many options as you get in IRA. That was my whole point of saying all that. So let's see here what sort of questions we have. All right. Okay, so let's see here. So Susan asks, she has a 0 muni bond ladder. So what that means, folks, is these bonds are not going to pay out coupons over time. You're just going to get paid out once the bond matures. So you're not going to have to pay taxes on those each year. And those can be just fine. So with COVID-19, are there any chances of defaults? My bonds are held to maturity and lately have been buying insured bonds. So, again, this is not something I've researched in depth. Okay, so take this for what it's worth. But if you're looking at some of these cities that have been affected by some of these riots that have been going on lately, you're looking at Minneapolis. You're looking at some of these cities that have just been really impacted by some of the protests and riots lately. If there were projects that were going on that area and you had municipal bonds that were designed for those particular areas, yeah, there might be a chance, right? There might be a chance that could definitely happen. But in general, you don't see a ton of defaults, but there is, a risk to those things. So these are things that you definitely want to consider and really bring into your overall portfolio. So back to your question, Susan, is that if you have a 0 muni bond ladder, there is a chance of default, but there's always a chance of default. And right now, as I mentioned just a few minutes ago, folks that are managing these bond portfolios are potentially going to be reaching to lower quality bonds, which means, lower credit quality before higher yields, right? Because if you want to go with super high quality bonds, what are you going to get right now? 0.5%, 0.25. It's like you might as well just keep your money in a high yield savings account at that point, right? So ideally, you want to get more than that. So having those that global diversification and the different types of bond categories can really do quite well. And so far this year, I'm seeing a lot of bond funds that have done between 5 and 8%. Not bad. I've seen bonds that did 2019, same thing, even up to 15 or 19% in some bond funds in 2019. So, over long periods of time, generally stocks outperform bonds, but there are definitely periods where bonds outperform stocks. So I do believe in diversifying there. I don't believe you should have all your money in, just stocks unless you're maybe very, very young, below 30, for example. You could take a lot more risk. But if you're in the 50s or 60 age range, I think you want to include some sort of fixed income, which would be bonds of some sort, maybe some cash, so that you can weather the storms if you were to be facing this as you're getting close to retirement. One big thing that I'm seeing now is that people are within 1 or 2 years of retirement and they're sitting at 80 or 90% stock portfolios, okay? Maybe if you don't need the money, if you have a pension that's going to come in, that's going to take care of all your needs, and you're not going to need to touch your portfolio, maybe that's okay. But for most folks, if you're within 2 or 3 years, you probably want to dial that down on the risk level on your portfolio. And then once you get going in retirement, you're in retirement 5, 6, 7 years, you got your Social Security kicking in, you got your pensions kicking in, you can always consider upping the risk or upping the equities in your portfolio at that point. That's called a rising equity glide path. And that can help you with those returns over the long period and for your legacy as well. Because once you get to, usually mid-70s, 70s, 80s, a lot of folks don't need a whole bunch of money from their portfolios if they haven't used it yet. And so that's when you can increase risk down the road. So definitely things are things you want to consider. So, Okay. So this is a good question here. Mark asks, Mark uses Vanguard funds for stocks and bonds. So I know you have low costs there. So that's probably a good thing. Is the current environment, a short-term bond fund or intermediate better right now? So it's a really good question. I would say both, to be honest. I don't think you want to just have everything in short term. I think some intermediate term is going to be good as well. But I would lean more towards any money you need in the next, let's say, 2 to 3, maybe even up to 5 years. You can keep those in more of a short term because you want to keep that money safe if you're going to need it in the next year or two. But any money that's beyond 5 years or more, then you can start looking at those longer durations. So that 5 to 10 years is that intermediate duration that we talked about. So really, really great question. All right. So let's see here. So Patricia asked a question here. With the Fed coming out of purchasing bonds, how do you feel that is going to affect the overall bond market? I don't know. These are one of these things that like the market right now seems completely unattached from reality, right? There's chaos going on around the country and the market overall, it's going up and down a little bit here, but overall it's doing just fine. We're not anywhere near what we were looking at in February or March. So these are things that in the short term, I don't really want you stressing out about too much. Your investment portfolio should be for the long term. So if it is something you're concerned about, as I keep, hammering this home, right? Keep beating this drum. Anything 2 to 5 years, you might want to keep that a much shorter risk. But if you're in high quality bond funds, you shouldn't have too much risk of default or fluctuation. And if they're short term, that should, keep things where they need to be. But we don't really know exactly what's going to happen over these next few years because this is quite a unique situation we're in. And as you see, I don't know if you're paying attention over what's going on in China, but they've now shut down Beijing again and shut down flights and people leaving there. Last time this happened, about 50 days later, we saw the reaction in the U.S. So again, I'm just watching these things and seeing what's going on. But it really depends on how this COVID situation plays out. Because if we're lending money to companies and to governments through our bond purchases, well, if those companies or governments have problems and need to claim bankruptcy, that's going to cause problems. But if they don't, because things were rescued, like as we had through our EIDL and our PPP loans that came out, a lot of companies are staying afloat. We're not going to see the defaults because they're going to continue to make those payments. So again, these are all things that you want to consider for your overall portfolio. I think they're very important, but that's also a very, very good question. So hope you folks found this useful today and entertaining. If you are considering readjusting or you want to talk about getting some help with your overall allocation with your portfolio or you need help investing in your portfolio, reach out. I would love to speak with you personally. You can schedule an appointment with me at keepitsimplefinancial.com/talk. That's keepitsimplefinancial.com/talk. We definitely specialize in helping people set up their retirement investments in a way that aligns with their risk tolerance, their long-term goals. And really, I think it's important as well that something we do is we provide education, right? So I'm a big fan of educating my clients on things like what we're talking about today. I obviously get a little bit more technical and I get very specific about your individual portfolio when I'm helping you personally when we're designing this. So these are things that need to be diversified according to your risk tolerance, your goals, your needs, and your time horizon. So I'd be happy to speak with you. I'd love to chat with you about that. I have some appointments available in the next couple of weeks here. So you go to keepitsimplefinancial.com/talk. Other than that, folks, I'm going to wish you a happy Father's Day. My dad's actually calling me right now on the phone. I'm going to try to pick that up. You have a great day. Talk to you soon. Bye-bye now.